Welcome to the Circle of Trust, the podcast where campaigns and strategies to grow law firms are unveiled. Hosted by law firm Chief Marketing Officer Keith Dyer, the founder of LEXGRO, this podcast is dedicated to being a safe and objective place to educate and train law firm owners and personnel on the marketing secrets and strategies that bring in consistent cases and predictable revenue. Whether you're a solo practitioner, a small firm, or a multi-partner law firm ready to scale, this podcast and the LEXGRO platform are your trusted go-to source for objective and cutting-edge marketing and intake training. And now, Law Firm Chief Marketing Officer Keith Dyer with The Circle of Trust.
Hey, good morning, everyone. Really happy today to have a couple of special guests on that are going to talk about law firm financing and some of the requirements that law firms would need in order to get capital to grow their firms. I'm going to welcome Don Springer and Joseph Joey Evans. We call you Joey, right?
That's
Joseph,
correct.
Joey and I have known each other for a while through a law firm. So that's why we call him Joey. Anyway, I digress, but these guys are from Capital Bank, and they're here to talk to us again about how law firms can get financing to grow their law firms. And so this is part of an overall course that we're building here, and we'll kind of dive right in and just say, tell us about your company history and how you guys got into the business of providing loans to law firms. And I'll just stop there, and you can give us a little bit of background on yourselves as well. But just go ahead, Don, and you start off.
Yeah, certainly. So thank you, Keith. My name's Don Springer. I'm the National Sales Manager for Capital Bank's SBA Lending Group. The majority of the work we do for the bank is through the government guaranteed lending programs offered by the U.S. Small Business Administration. Been doing commercial lending for the better part of 2 decades now, and specifically in the SBA space for about 10 years. And Capital Bank as a whole is based out of Rockville, Maryland, right outside of Washington, D.C. We're a nationwide lender, a nationally chartered bank, started in the late 90s by a group of local business people in the DC metro area. In 2017, we ended up going public through an IPO, and we've taken our bank on a national platform, at least from a lending cycle, right? And we do deals all the way from Seattle, Washington to Miami, Florida, and everywhere in between. We've helped various customers, including a lot of law firms, to gain access to capital that they need to either start their practices, grow their practices, invest in real estate for their practices, and anything and everything in between. So we're really focused on how we can provide access to capital to small businesses when a lot of companies, a lot of banks and lenders don't necessarily don't see operating companies as attractive lending borrowers. They're looking for real estate. We are more generalists, can really lend to those operating companies, which include law firms, and really try to understand what the needs of the clients are so we can help them path their future and how they grow their businesses.
Great. Did you want to add anything in there, Joey? Or
Yes. Don and I have worked together for years as well, so we have a very good chemistry. As he said, he is the national sales manager. Very strong bank that we have, very family oriented, and that really is accountable when you start working into these law firms, simply because they are family businesses usually too. We do deal with several conglomerates. I've dealt with them before. But mostly they're smaller captive law firms that are more probably local in scope. We have dealt with law firms that cover various states. So it's been a pleasure to work with those guys, and certainly get to know you, Keith, and other associates that you have. My background, been in banking since 1999. Ran a small bank in North Carolina. Dealt with the commercial needs of law firms on a conventional level. Been dealing with specifically SBA for probably the last 7 years, and the market's really have shown a need for that, just simply because a lot of these law firms are trying to expand, and capital is paramount. So when it comes to understanding how they work, from family law to criminal law to just basic wills, estate planning, so forth, I've had the pleasure of really meeting a very diverse group, and I'm learning every day because every firm's different. But it's really been a pleasure to get to know the business. It's brought a whole new respect from me to certainly the legal industry, because I see what they do for people. And as a bank that's more family oriented, trying to really get small businesses in play, it's something that we've really latched onto, and want to grow that sector. So we do appreciate the opportunity here to at least share what we can do, and offer any advice or help that we can give.
Well, I appreciate that. And I'll just, for the audience, just let everyone know that I actually have worked uh, indirectly to an extent with Joey in providing capital for a particular client of mine, which is how we came in contact, which is also an old friend of ours. So, and that capital has done a lot for this particular client's business and growing his firm. So that's how we sort of all know each other, right? I just want to put that out there. I'm going to dive right into basically some questions here. And in your opinion, when should a law firm be looking to acquire capital to grow? Like, is there a specific point in their growth, or just expand on that if you could?
I'll be glad to start. Don can certainly add into this. Typically, any firm in any company are going to be doing strategic planning for the coming year. Certainly, as they grow into other areas of law or either geographical areas of law, they're going to be preparing business plans or growth strategies, especially on the side of capital needs for that growth. And typically, what I've seen is about 4 to 6 months out, they know what they're wanting to do. There are opportunities that obviously come up that are shorter time frames than that, but typically 4 months, 5 months, they're going to know what they want, and I would say that's when they probably would want to engage their lender to basically run through that projection, run through that growth model, and so we can start that process of helping educate on the financial side to how we get to that. There's been many times where firms have thought they needed X capital, but as we did the projections, what they really wanted to do as far as staffing, bringing on paralegals, bringing on certainly attorney partners, those needs are bigger than they thought. And what we do is go in and try to analyze that to make sure that they don't basically shortchange themselves, because the last thing you want to do is get into a situation where you're doing a good job, you're growing, and then all of a sudden you feel like your capital needs were short, derived from a shorter than you thought.
Yeah, you get stuck, right? You get in a bad spot.
Yeah, we don't advocate borrowing any more than you need to. We're not that kind of lender, but we also advocate getting what you need, especially in an environment like the SBA, simply because you there's no prepayment penalties with most all these loans. So if you realize that your plans change and you feel like the capital needs weren't there, obviously there's you can facilitate those payments back and go from there too as well. So I'd say to recap your question, 4 to 5 months And Don, you certainly feel free to add into that.
Yeah, and I'll address the question from a kind of a different perspective, Joe. And I think that's great information, and you're spot on, right? And so when I look at this question and understand the question and how I think through it is, I look at when to borrow money and what sources of capital are out there, right? And I think there's an adage, and you hit the nail spot on, Joey. You borrow money for strategic growth, right? For the positive. We see from time to time, whether it's law firms or other industries, where companies, small businesses are trying to borrow themselves out of financial difficulties. And, that's not the time to borrow money, right? The time to borrow money is when you're looking into the future. You look at today, what you're doing today, you're looking into the future and saying, okay, in the next 6 to 12, 18, 24 months, I want to be at X times 2, X times 3, X plus 2, X plus 3, whatever those metrics are for you. And then find the capital, go solicit and find the capital needed to secure that growth and finance that growth. So I think you always want to go into a borrowing situation with a clear strategic plan on how you're going to deploy those use of proceeds and that financing, so you can get a return on investment as you borrow that money. The second thing I'll bring here is kind of the different sources of capital that we see in the marketplace, and kind of the pros and cons of the different sources of capital. Obviously the cheapest sources of capital are friends, family, money. And a lot of folks, when they're starting their businesses, that's where they turn to, right? And they don't think they can get bank financing for whatever reason. They don't want to talk to somebody like Joey or Don Springer. They want to go to their families and friends and say, I have this great idea. Here's my business plan. I need help on the financing side. I need some money. And, the least invasive and kind of the cheapest form of capital is that friends and family money. Then you have the equity side, right? Where you can go out to the market and get investors to raise equity as a form of capital. It tends to come with some strings attached and giving up a percentage of your company, right? People aren't just saying, here's $500,000 to invest in your company. When you make it back, just pay me back. They're saying, hey, listen, give me a certain shares or percentage of your company. And, I'll look for either dividends or distributions, or when you go to sell your company or you're wildly successful, I'm going to look to get paid back. In my perspective, and kind of in my opinion, that is the most expensive form of capital. And the reason I say that is the more successful you are, the more expensive that money gets, right? If you give
Right.
up 5% of your company today for $500,000 and you're throwing off EBITDA of $20,000 today, but then you can grow that to throwing off $2 million worth of EBITDA, and you go to sell your firm at some point in time because you want to retire. That 5% just got more expensive because of your success, right? So your cost of capital goes up tremendously on the equity side. And then you got the debt side, what Joey and I do from a banking perspective, right? And the good news about that, it's very structured. The terms of the repayment are very structured. You know what you're getting yourself into from the forefront. You know what your interest rate is going to be, and kind of your cost of capital over a period of time. And it really tends to be probably the best source for small businesses, including law firms, because that friends and family money dries up pretty quickly, right? You can
Sure.
only go back to that well so many times.
And you have the personal relationships that are involved as well, which, if those are damaged, it could last a lifetime.
Correct. Nobody wants to show up at Thanksgiving when uncle is giving you some money, and
Right.
you have to have a tough conversation over turkey dinner, right?
That would be a very tough one. Yeah.
Exactly. So, and I think from that perspective, that's why we can add a lot of value to businesses, and not just on the side of, okay, what can you borrow, but the way we approach the business is kind of, I hate to say it, that old school banking model. It's, even though we have some fintech abilities and we have some, online loan origination systems and some financial metrics that we're building in to make the process more efficient. My strategy in running this group and this team at this bank is to hire folks like Joey Evans that have a banking background, that understand to sit down with clients and small businesses and say, really have that conversation. Where have you been? Where are you at today? And where are you going tomorrow? And let's talk about those three aspects, and let's help you from my perspective on more of a consulting side, map out a financial plan, whether it's deposit accounts, whether it's treasury management services, whether it is lending facilities, term loans, whether it's lines of credit. What do we need to do to help you deal with what your balance sheet looks like today, and also how to grow your balance sheet to where you want it to be tomorrow? And those are the level of engagement that we look for with our clients. And I think that's how we add a lot of value to our clients' businesses.
Yeah, I like it. It's very hands-on, and it's got a exit strategy, right? So, where the other two ways of describing, loans don't have a clear exit strategy. Does that make sense what I'm saying?
Sure. Yeah, I think that's spot on, right? I mean, and you know what you're going to repay on the loan side, right? You know
Right.
how much it's going to cost you from the get-go. On the friends and family side, there's potential relationship damage, right? Even though you might be able to pay it back, or it might not be so bad, no matter how long it takes you to pay back. But you never know what those personal relationships are going to suffer if things don't go perfectly. On the equity side, again, like I described earlier, the more successful you are, the more expensive that money just became based on your success. And it's a necessary evil at some point in time. A lot of people get involved in it, and it's really good for if you're looking to rapidly expand or rapidly accelerate above and beyond maybe what a bank would be willing to provide in capital. A lot of folks come to us and say, hey, listen, you can get us to X amount of debt on the debt side, but our business plan, our projections, kind of where we're going, needs more than that. So they do a combination of equity, or maybe a smaller amount of equity raise, and then use our debt at the same time to kind of bridge that gap. So there's strategies to play when all three of those perspectives and how you fund your business.
Sure. Okay. Well, that makes sense. Kind of explain some of the types of loans that you provide, maybe expand a little bit more on the SBA loans, because I personally have used SBA loans, currently using an SBA loan for my own business. And I see a lot of advantages, obviously, to using the SBA, and a lot of the coaches and programs that I've been a part of have always been a proponent of using the SBA loans. So tell us a little bit more about some of the types of loans that you provide to law firms specifically.
I'll be glad to sort of start that off, and obviously Don share his knowledge, but most of the time, law firms are looking for capital that is mainly and largely unsecured. We do understand the lack of capital a lot of law firms have, simply inequity, of course, too. But we also understand the longevity of income stream that law firms experience, because when they start a case, first of all, there's a lot of generation of advertising, massive amounts of advertising, and to get those cases. And then when they get those cases, it could be, as most attorneys that would be listening to this know, anywhere from 8 months to 2 years, on some of these larger cases. So a lot of the capital needs that are needed aren't able to be secured by conventional means. So the 7A program really comes into play because it is a true facility that enables capital to be deployed based on their needs, specific needs at that time. There are other loans. We've helped with buildings, infrastructure, construction to perm loans when they want to build and buy their own, law firm locations, etc. So, but typically it's the 7A program that benefits law firms the best, just because of the capital need in itself. So that is with the one.
So there are different types of law firms. I think you're describing and what you just said is more of a personal injury scenario where firms don't get paid. It's contingency based, right? So that you're used to. That was the kind of loan that you provided one of our clients, but you would be willing to provide loans to non-contingency based firms as well. It would actually probably be less risk in some ways involved in that, and it might be a different type of loan. Or would you still recommend the 7A?
Well, I'll give you an example. We deal with family law. We deal with there's all types of it's not just from criminal defense or litigation type industries. There's structured fee firms that, as you know, are out there that still need capital to
Of
grow.
course, that's what I'm alluding to. Yeah.
Yeah, so they depends really, Keith, on their needs. I mean, if it's true capital to hire employees, cover costs, carrying costs, operating costs, things like that, 7A is still perfect. If they're looking at moving into a new area, buying a new building, in addition to, then it might be a mixture of a 504 and a 7A product. We've done both. We also handle lines of credit that could be very
Better
valuable.
option. Yeah, it could be a better option. Yeah.
And Donna, please share.
Jump in a little bit. I think when we look at contingency-based law firms, non-contingency-based law firms, the underpinning definition of that is how they produce their revenue, right? I mean, really what we're getting to is revenue composition. And I'll be a little bit more general than Joey was there and state the fact that we're cash flow lenders, right? We're going to look at the cash flow that either the firm has historically generated or what they're projected to generate in the future. We're going to understand the revenue composition and the feasibility based on some, industry statistics of being able to continue generating that cash flow. What we really look for in these cases when we underwrite loans and we start to engage is that the firm itself or the borrower itself is able to generate about $1.35 for every dollar of loan payment they're going to make, right? That's the metric we really look at. And how you get there, it doesn't matter to me to some extent. I know this is more a law firm based thing. I don't care if you're selling hamburgers at a retail shop or you're doing contingency based or non-contingency based fee structures under a law firm. I look at it as cash flow and cash flow composition. Can the revenue be generated, the expenses be controlled to the point where the bottom line, the EBITDA and or cash flow, kind of synonymous terms, are able to generate and be large enough to service the debt that's being requested.
Yeah, to make the payments. Yeah.
Right. You've got to be able to make the payments, the ability to repay. We hear this term all the time in the mortgage world, right? The ability for the borrower to repay. We can throw all the fancy terms out there we want: debt service coverage ratio, cash flow, EBITDA, leverage, whatever it means. But what are we really looking at? If we lend you $1, we want to be paid back over time $1 plus the interest rate that we're charging on that loan, right? Everybody thinks banks get rich off of defaulted loans. We don't want to default a loan. I don't want to collect collateral. I don't want to liquidate SBA guarantees. I don't want to go through a legal process on that. It's funny talking to lawyers. What I want to do is say, hey, Mr. Law Firm, Mrs. Law Firm, here's a $500,000 SBA credit facility, whether it be a term loan for permanent working capital, FF&E, leasehold improvements. It's a SBA cap line or SBA express line of credit to help you finance your short-term working capital needs that's going to fluctuate as a revolver, or whether it's a loan to finance, you're sick of leasing that building, you're sick of paying your landlord's mortgage payment, you want to go out and buy your own office, and we're providing owner-occupied commercial mortgage for you to purchase that. What I really want to do is make sure you have the ability to repay that loan over time, right out of your cash flow. And that's how we look at it from that perspective. So I think I baked in some of our kind of our products and tools that we use to help folks, the structures of loans, whether it be a term loan, line of credit, commercial mortgage, to kind of mix into that conversation. But at the end of the day, we're really measuring the ability for that small business to repay our loan and the probability for it to be repaid over time.
Yeah, I mean, that makes complete sense. And so what are some of the actual physical documents or requirements in general, you don't have to get specific, but in general, what are some of the things that are required by law firms that are looking for financing that they need to provide? I mean, what kind of reports, or of course, obviously there would be an application, and what are the financial things that you look for inside the firm to be able to determine whether or not they're able to pay it back?
Yeah, I'll keep going a little bit, Joey, here, and I'll let you put that clean up on this one. I'll say it, as far as financial documents, pretty standardized, right? You're looking for 3 years worth of tax returns on the business side, 3 years worth of personal tax returns, year-to-date financial statements, AR, AP reports, and this is stuff that we can get you a list and probably work with your bookkeeper, your CFO, or your accountant to get a lot of that information. It's really just document transfers. So that's part of it, right? But what I really like to focus on in sessions like these, Keith, is what are the documents that take a while to develop, right? That you might not be able to call your CPA and say, hey, send Joey Evans over at Capital Bank my 2020, my 2022, and 2023, corporate returns so he can analyze this loan. So I think that the couple documents that we see in our practice that take a while to be generated, one is a business plan, right? I believe, and I'm a firm believer, whether you're borrowing money or not borrowing money, that you should have a business plan in place from the day one you start your business. And it should be updated periodically. It's a great measurement of time to say, all right, listen, I'm going to check in every 6 months. What are we doing right? What are we not doing right? Where are we hitting what we thought we were going to hit? Where are we not hitting? Where are we executing? Where are we not executing? So business plan is paramount to me as a lender in working with a small business borrower to make sure that they really have planned and strategized on how this is going to work. So, and that takes a while. Some companies have it. Some companies, you would be amazed how many companies have never even thought about writing a business plan. It kind of, a law firm fell into my lap, right? I was an associate somewhere and I wanted to branch out on my own. I got this little office and my practice grew, and here I am. Now I have 4 attorneys on staff. I have 2 paralegals. I have whatever it might be, and I really don't have a business plan. So I think honing in on either having a business plan today, developing one, or updating your business plan based on what you're going to do with the growth capital that you're seeking is paramount. The second thing is financial projections, right? So a lot of times what we're seeing, especially on the growth capital side, is somebody's coming to us saying, hey, historically I've made $50,000 a year as EBITDA or cash flow. I want to borrow $500,000 and I want to grow that EBITDA cash flow to $500,000, $750,000, $1 million, whatever that number is. What we look for to document that progression is financial projections. And what we tend to ask for is 3 years worth of financial projections. The first year broken down on a monthly basis. This is going to be my revenue. This is going to be my revenue composition. This is going to be my fixed expense. This is going to be my variable expenses. And here's how much money I have left at the end of the day from a net income perspective. That exercise, I think, again, is something every business should go through at least on an annual basis, because it coincides with the business planning aspect to be able to not only plan what you're going to do on the financial projections, but how you're going to do it on the business plan side. So, those are the 2 documents. And then the personal financial statement takes forever. Nobody likes filling them out. It's like homework when you were in high school. Oh, I got to fill out another form that shows everything that I have. I have to go look up all these accounts. I really don't know what I have. So that's another document.
Very sobering homework.
Right. Listen, I have kids in high school, right? I have to kick them in the rear end to do their homework every single night. So I totally get it. But at the end of the day, it's a necessary document. And really, the reason I bring those up, Keith, is that those are the documents that we request early on that tend to take a lot of time, right? So when you're talking to your audience about, or your audience is looking at this or reviewing this and saying, okay, I think in the next 2 to 3 months, I'm going to need to borrow some money. I have a plan, or I have an idea. This is what they should, before approaching the bank, they should start thinking about those 3 documents specifically.
Sure, because they can take weeks or even up to a month or so to complete, maybe even more, depending on the size of the
Correct.
Yeah.
Correct.
Great. Joey, did you want to add anything to that, or you?
Yeah, the only thing I would add in is one of the things that I've realized is, to any industry, a lot of times the owners, the principals, when they're looking at what they need, would be surprised that number changes when they actually do their projections, because we can all have it in our mind what we need to grow. But when you really put the pen to the paper and you see what employee costs, your own salary, because you got to get the principal's got to get paid too, and you start going through those, and then your advertising expenses, etc., and then that number pops out at the end. I would say more than not, I've seen people surprised they were a little off, and that's why the projections, as Don said, are so important, because it really helps them track where they're going.
Sure. And I
You
mean,
know,
And it's humbling, right? I mean, a lot of times what they'll see is that for the first few months, that number's in the red, right? Because the expenses are outweighing the revenues because of the growth and the injection and the expenses of marketing, advertising, office space, whatever it might be. And like Joey said, there's the borrowing need, right? If you think about it, if I know that I need to invest X amount of money in advertising and so forth, and then I see at the bottom line I'm negative $100,000 month one, I know, how am I going to fund that $100,000? In month two, I'm negative 50,000. Month three, I'm negative 25,000. I don't turn cash flow positive till month six. I have to have enough capital to be able to fund that growth until I can become cash flow positive and continue to fund it myself, right? So that's kind of the generation there.
yeah, we call it in the firms that I work with the runway, right? You've got to have enough run. You got to, Joey. I'm sure you've heard that from one of our clients, but you got to have enough runway and enough gas, for the plane to get off and enough momentum for the plane to get off the tarmac before it or before off the runway before it crashes. So that's extremely important. Yeah. So this has all been great information. I mean, I think one of the big things I take away from this is to, have a plan, start planning your plan before you would normally think of it, right? And the thing I love about you guys is that you seem like you're very much on the side of the firm that you really want to help them, and you really want to dig in and say, okay, let's figure out what we need, really what we need. And you guys are hands-on in that process. That's what it feels like to me and what my experience has been. And I've really enjoyed having you on today. What else would you like our audience to know about borrowing, or anything else you'd like to add?
Yeah, I think, quick plug for our team, but I think one of the things we do well is it's not just Joey and I, right? And I think that's one of the things that's very important here. We have a staff of 15. We have dedicated underwriters to our clients. We have dedicated closers. We have dedicated servicers. So we manage the relationship over the life of the loan. We don't pass the buck to somebody else. We don't outsource anything. It's 100% contained at Capital Bank within our purview. And I think from a borrower experience perspective, that means a lot, right? It's a very personal transaction to borrow money. And I believe that, right? You're sharing a lot of data about yourself on the financial side and your planning side. So if I was on the other side of the table borrowing money, I would want to work with an institution that contains everything in-house, right? I don't want my data being shipped to 5 other places.
I mean, that's huge.
Different people, so I think that's one of our value propositions, and we sell this in the marketplace a lot, is you see what you get, right? You're dealing with folks that are associated with Joey and Don and are employees of Capital Bank. They're not third parties. They're not service providers. They are 100% dealing with Capital Bank. And for the most part, the life of a loan will be dealt with within the same 15 people that we work with on a day-to-day basis. So we address that personal conversation and that personal information conversation really, really well. And we're relationship guys, right? We're relationship bankers. At the end of the day, it's about relationships. It's not about a transaction. And our ultimate goal is for you to have a relationship with us for over years. So the next time you want to borrow new money or need to borrow money, you're coming back to us to talk to us about, where you're at, where the next step of your business looks like, right? So that's really what I want to convey, Keith, into this audience.
Yeah.
And I will back that up with one more comment. I want to make sure your audience understands that, when we talk about projections and these forms that we need up front. Their expertise, most respectfully stated, most of them, their expertise is taking care of families that need compensation, that have been hurt or endangered by no fault of their own. Our job is to help them succeed. Now, having said that, when they think about projections and we're talking about those things, and those forms can be intimidating to anybody. But what we do is once they have those filled out, they can certainly call me, call Don, call our team, call me specifically. I'll be glad to help and go through those with them. They're not on their own. They have to provide them up front because it's their projections, but we will go through them line by line to make sure, after consulting and certainly talking about what their growth plans are, they, to the best of our responsibility on a fiduciary side, try to match those up. And
Sure.
they're not alone. I hate using this term, but we try to hold hands as much as possible through the process because it's not what they do every day.
That's
You know,
right.
just
Yeah. I love
threw me
that.
into the courtroom, they might throw me out because I don't know what I'm talking about when it comes to some of these very high intense cases that your clients deal with. But in our arena, this is what we do every day. Don's, as he stated, has 20 plus years experience. Between Don and I alone, not counting our team of 15, there's over 45 years of experience on this podcast. So we don't know everything, but that's the great thing that Don said about our team. It's an ever-changing market. So the things that we don't know, we talk almost every day. Don can attest to that, our team. Certainly once or twice a week, and share ideas. Different parts of the country react differently to different needs. So we rely on our team to educate each other, and hopefully we can parlay that into into the people that we try to help too. So
Yeah, the fact that you're relationship oriented, I think is very big. People want to work with people that actually care about them, right? And actually want to help them succeed. And so I think that's huge. And the fact that the loan stays within the same family throughout the duration of the loan is also a very big feather in your cap. And I think our audience and our clients will benefit from that. And that's one of the reasons why I wanted to have you guys on here and to talk about this today. And I've really appreciated it. It's been very informative. I'll open it up to any other final comments you'd like to add in?
Thank you, Keith. Thank you for
I just want to
thank you for allowing us.
Yeah, I'm glad
Absolutely.
to have you. Thank you for being on. And we're going to provide a financial projection basically workbook, an Excel workbook that we're going to provide as a download. We're also going to have an information sheet for your bank for everyone. With that said, we're going to wrap it up here, and I really appreciate it. I'll be in touch with you guys soon, I'm sure, at some point.
Perfect.
Thank
Have
you.
a great weekend, Keith.
Thank you. Bye-bye.
Bye-bye.
Thank you for tuning in to this episode of The Circle of Trust. If you found today's insights valuable, consider subscribing, rating, and reviewing on your preferred podcast platform. Your feedback fuels our mission to bring outstanding content. For additional resources, show notes, and exclusive offers, visit our website at LEXGRO.com, where you can join our platform for free. By joining the platform, you can take our marketing training to become certified in law firm marketing and intake. And you can hire fractional executives and trained virtual assistants to easily implement your marketing strategies. For those ready to take action and explore how a fractional chief marketing officer can transform law firm success, scheduling a strategy call is just a click away. Simply follow the Calendly link in the description box below. Remember, the journey to 7 to 8 figures starts with the right strategies and support for implementation. Join us again next time for another exciting episode. Until then, listeners are encouraged to keep innovating, growing, and uncovering the secrets to predictable and consistent growth. See you next time on The Circle of Trust. Let's grow with LEXGRO.